The CNBC App. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC App today.
Welcome to Squawk Box Europe. I'm Karen Cho with Steve Sedgwick and Juliana Tattlebaum. These are your headlines. President Trump hits Brazil with a 50% tariff despite the US having a trade surplus in goods with the country, citing the prosecution of former President Jair Bolsonaro.
Wow, this is huge. The world's biggest company getting even bigger. Nvidia, the first company in history to breach $4 trillion in market cap as investors pile back in on AI bets.
And Kellogg shares spike in extended trade amid reports Nutella-maker Ferrero is nearing an acquisition deal in what would be a rare European takeover of a U.S. rival.
Good morning. How are we?
Very well, thank you.
Did we all sleep?
Yeah.
So we're raring to go. Yeah, small children. That's the problem with you guys. Mine are just like on a different time scale. Now, look, here's the thing. A good set of headlines will encapsulate everything our viewers to know in that snapshot. And I think they were a brilliant set of headlines. I don't say this about the producers very often, but I think they got it right.
They packed a punch, each one of them.
It was punchy. They were right. They got all the top stories, So yeah, there's faint praise. But look at it. You've got once again another lambast for another country from the administration. Always the top story, what Trump's up to, but fascinating. At the same time, and I find this extraordinary, the market is ignoring it, completely and utterly ignoring all the problems out there. Nvidia hitting $4 trillion. 2 years ago, it wasn't even $1 trillion. It passed $1 trillion 2 years ago. And now, I was just reading Dan Ives' piece, and this will be my final point there as well. He says it's only a matter of time before we get a $5 trillion company now.
To me, the headlines are all about size. The size of the US in terms of hitting other countries with tariffs, the size of those tariffs, Nvidia in terms of the size of the company now, market cap, and in terms of consolidation attempts in the confectionery area about creating some size, some market scale. So to me, it was really about some sort of weighting that you've got in terms of your position in the economy globally.
It is a pretty well-balanced set of headlines that are top stories today, I would say.
No, we don't want to over-compliment the producers. We've done that bit now.
Well,
Let's move on and lambast them as usual.
Did a great job capturing the news flow. So the news flow has offered a real well-balanced set of stories today. You got the micro with the Kellogg Ferrero story. Really interesting to see a European rival potentially looking to take out a U.S. rival. When I first saw the Ferrero Kellogg story, I thought it was the other way around.
So did I.
Yeah, it's not usually you'd see that. So we'll talk about that one a little bit later.
Coming from my chocolate side, I've got to say, chocolate's done particularly well in recent years. So I think hence the reality they've outpaced some of the cereal producers that used to be the lines in the space a decade or so ago.
I'm just disappointed we didn't get more puns in the headline, like, they're great, or Mr. Ambassador, you're worth it. I don't know, whatever, anyway.
Oh, you've written them for the next hour.
I don't know about that. President Trump has announced Brazil will face a tariff of 50% on all exports to the US from August 1st, sharply ramping up the rate from the 10% announced across the board, of course, in April. The US leader cited ongoing prosecution of the former President Jair Bolsonaro, as well as what Trump described as very unfair trade practices. Well, can I just jump in here a second? I'm pretty sure the Brazilians buy more goods off the Americans than the Americans buy off them. So what is fascinating is it's this anti-US policies line that came up 48 hours earlier as well. So this isn't just about trade. These tariffs aren't just about trade. This is becoming about, do I like the flavour of the government? And my understanding is that parts of the Bolsonaro former administration, parts of the family, have been lobbying the president to be a more hard line with Ignacio da Silva, who, of course, is the current president.
Oh, that's right. Should we get into the chat here? Because, or do you want to come back to it?
Oh, let's come back, because you start off next. However, the US are getting so much trouble. Yeah. The Office of US Trade Representative said that the US actually had a trade surplus. Yeah, that's what I'm saying, of $7.4 billion with Brazil in 2024. So this is about a whole host of things. This isn't just about, and I'll quote, unfair trade practices. The Brazilian real sank, really fell over a couple of percent in response to news. Brazilian leader Luiz Ignacio Lula da Silva, has vowed to respond with reciprocity. The US is continuing to send out updated tariff letters to countries around the world, with some of the big hitters, Brunei, Algeria, Brunei, Iraq and Libya amongst those who have received new rates. Moldova, Sri Lanka and the Philippines have also received letters with duties ranging from 20 to 30%.
And we'll also just round out on Europe here first up. The EU is reportedly discussing measures with the US that would see Europe's key auto sector being spared from a sharp increase in duties. That's according to Reuters, citing multiple sources. Possible solutions include car import quotas and export credits. According to reports, President Trump and his Commerce Secretary Howard Lutnick have signalled improved cooperation between the sides as they look to finalise a deal before an August 1st deadline. But circling back to the Brazil situation, because I think it gives us a lot of colour about the tricky nature of these negotiations, that it simply is not just about goods and trade. To your point, a trade surplus with Brazil is what we're talking about here. But the reality is the digital side is tricky. There's a huge social media business in Brazil. There have been thorny parts here. 2023, violent protests unfolded. Some of this thought to have been organised by online supporters of Bolsonaro. There was a strong pushback by authorities, seeing it as dangerous behaviour. And that type of behaviour has been witnessed elsewhere, countries like India, Indonesia. So they've taken a very strong approach to social media and what can spread through these platforms. Very different to Section 230 in the United States, where it's hands off. It's not our responsibility as platforms. Very different in Brazil, where it is the responsibility of the media platforms, very much like traditional companies. So I think it is that type of authority, that type of regulation that is now raising the hackles in Washington, where Trump doesn't want the owners on these platforms. And if you look at by numbers, 144 million users on YouTube, 112 million on Facebook, 140 on Instagram, 145 million on WhatsApp. So the digital side, huge business for these companies in Brazil.
I have to say, in terms of this going beyond trade, it was well telegraphed. Earlier this week, Trump came out criticizing the BRICS nations and that wider group now around the anti-American nature of some of their approaches. So the fact that his latest attack on Brazil goes beyond trade shouldn't really come as a surprise. I think in terms of markets, it's interesting that markets are pretty much shrugged off the news yesterday. And I think it's largely because they're waiting for the big deal now. And the big deal now is the EU-US deal. And so far, the signals have been pretty encouraging. The big deal was U.S.-China for a while. That seems to have, at least been put on hold. We haven't seen an escalation there. So now the big thing for markets is going to be U.S.-EU. And the signals seem to be moving in the right direction.
Your market segment is on the wall, so we'll move straight on. Unless you've got anything added to say?
No, I think let's look at how U.S. markets fared yesterday, because I think it is pretty telling that the Dow, the S&P, the NASDAQ all continued higher yesterday. The NASDAQ gaining about 1%, posting a fresh record high, and part of that was due to Nvidia, the company becoming the first to boast a market cap of $4 trillion on an intraday basis. The AI chipmaker has had a remarkable rise, having only hit the $1 trillion mark just over 2 years ago. And it's a far cry from its initial focus when it was founded in 1993, producing processors for video games and 3D graphics. What a run it's had. We'll talk more about the Nvidia story a little bit later in the show, but $4 trillion, wow. In terms of U.S. futures, this is where Wall Street stands right now. We are looking at a bit of a pullback. The Dow looking to retreat about 100 or so points. The NASDAQ looking to pull back about 70 points, and the S&P also looking at a slightly weaker start after the strong session yesterday.
If you are already on the FOMC and you were auditioning for a job that may or may not become available next May, I don't know, you would probably go for a rate cut this time round. Not that I'm saying anyone's got their eye on the future, but it was interesting that two FOMC members went for cuts made as soon as this month. Michelle Bowman and the aforementioned many time Governor Christopher Waller. Right, minutes from the Fed's latest meeting showed a divergence. I just mentioned a bit of it amongst members over the future rate path, with concerns split over between signs of tariff-induced inflation and hints of weakness in the labour market. The minutes showed a couple of officials, I just mentioned that, who could see a July rate cut, while some argued that no rate cuts will be needed this year. Wow. The Fed is due to announce its latest decision on July 30th. Oh, it's easy to negotiate. Easy for David Seif, who is chief economist at Developed Markets at Nomura. David, we had a lovely little chat beforehand. Nice to see you. So how are you?
Very nice to be here.
And thank you for joining us as well. It's not easy, of course. It is probably one of the trickiest jobs in the world. How do you think the Fed is doing negotiating, well, this plethora of challenges it's facing?
Well, the Fed is clearly being pulled in two different directions right now. One is that I think that the cooling, but not collapsing labor market makes it want to cut. And I think
cooling.
I think it is cooling. It's cooling, but again, I want to emphasize not collapsing. So we are seeing a slowdown in private jobs growth. We're seeing that the jobs that are being created within the private sector are concentrated within a relatively small number of industries. And that definitely does make it a little bit worrisome that that number is about to fall a little bit more. But we're certainly not seeing anything that's sort of commensurate with a recession or anything like that in the United States. So we're above neutral, I think, the Fed is, in terms of the Fed funds rate. And given where the labor market is going, I think that all else equal, they would be cutting a little bit more than they have so far.
To what extent do you think the expectation of cuts from the Fed is what's driven equity markets higher from here?
I think that equity markets have gone higher more recently because I think the impact of Trump's tariffs have not been as severe on the economy as a whole as has been seen. So I don't think that the Fed has really been the driver of this. I mean, if you go back to April, the market was expecting there to be 4 Fed cuts by the end of the year. Now it's expecting between 1 and 2. So if anything, the sort of surprise, so to speak, in terms of what market expectations are going to be for the Fed has been fewer, not more cuts. So I think it's sort of in spite of that, actually, that markets have recovered. And it's because the economy, the real economy, has held up pretty well with respect to tariffs.
To that point around the expectation shifting from deeper cuts to more subtle cuts, this messaging was coming through from the Fed too, that, look, we might be close to neutral. How do you assess whether we're going to get to the point where we're not providing any stimulus and we're not tightening? We're just going to be at some sort of neutral level for the Federal Reserve when it comes to rates? Yeah, I mean,
it is incredibly difficult in the short run to figure out what neutral is. Even looking back, it's hard to do, so let alone in the short run. I think that with a couple exceptions, most FOMC members and importantly Chair Powell do seem to think that we are still a little bit in restrictive territory. And I think that that's correct. That's what our analysis would say as well. But the Fed isn't sort of slamming on the brakes anymore. It's just sort of tapping on the brakes, so to speak. So I think that when the Fed has the opportunity, when it feels that tariff-induced inflation either is in the past or if it doesn't happen at all, it's confident about that, it will be cutting a little bit more. But again, we're talking about, in aggregate through this cycle, we think maybe 3 more 25 BIP cuts is really all that's necessary.
When July 9th was on the table as the tariff deadline, the expectation seemed to be that we would start to see an uptick in inflation around September. That's when we start to see the impact of tariffs. Now that it's been pushed out to August 1st, and clearly there's scope for it to be pushed out further given the track record of President Trump, to what extent could that impact the Fed policy path from here and the overall inflation picture if we're not looking at an uptick in prices until maybe early January, given that the Christmas period is before then, so consumers might not feel it as acutely?
Yeah, I think what's going on right now, July 9th, August 1st, whatever it ends up being, is actually pretty small. I think what really matters is the tariffs that have already been put into place. We went, when Trump took office this time, from a 2% average effective tariff rate, briefly touched 30, and settled now around 18. Looks like now on August 1st, it might go up, assuming the EU deal comes out all right, it might go up only 2 or 3 percentage points. So we're talking about a move that is really on the order of maybe 1/10 what we saw in April and preceding April. So I think really the inflation that we will or will not see over the summer is based on the actions that President Trump took in February, March, and most importantly in April, and far less on what's going on now. And I think the muted market reaction to what has been going on so far is because, yes, there's a lot of headlines coming out. There are a lot of countries being covered. But the big four are sort of the EU, Canada, Mexico, and China. And only the EU is really in discussion right now. And the expectation is that it's looking as though that deal is proceeding pretty well.
I think it's fair to say that Trump is a disruptive force when it comes to the macro. And Steve was just mentioning before about the Fed members and how vocal they've been in terms of posturing perhaps ahead of any future appointment of the next chair of the Federal Reserve. Bowman and Waller, for instance, are siding with Trump almost around the suggestions of the necessity for rate cuts. But when it comes to what we've had from the Federal Reserve so far, singing from the same hymn book, mostly in unity in terms of direction for the Fed, that seems to be breaking down slightly at this stage. What's the relevance here as we still wait for an onslaught of incoming data around the macro, while we need a Federal Reserve that is working from an independent stance to set policy that is right for the economy without some sort of political posturing around Trump? How are you thinking about these factors?
Yeah, I think so far it hasn't changed things all that much. But I do think it's important that we have the two Trump appointees on the Fed who have shown themselves to be the two most dovish members of the Fed, and frankly have certainly adjusted their position since President Trump took office, most notably with Michelle Bowman having a very sudden change just a couple of weeks ago.
Are you saying it's like having sleepers there?
I'm sorry?
It's like having sleepers. People you've appointed, you've put there, and suddenly you can activate them.
Well, I wouldn't go that far to necessarily say they're sleepers, but as Trump appoints more people, including the next chair, I think we could start to see the Fed behaving or interacting in a very different way than before. In the UK, for example, no one would be shocked to see Bailey outvoted by the rest of the Bank of England. In fact, it was less than 20 years ago that Mervyn King was outvoted in a 5-4 vote. It does happen here, and it's a real vote that takes place. In the United States, it is effectively a dictatorship of the Fed chair. Very rare to have dissents, and very, very rare to have multiple dissents. I think that as the new Fed chair takes office, if that Fed chair is out of line with the majority of the FOMC, we could start to get into a situation where we have to count the votes for the first time in the United States with the Fed, where we have to really sort of consider not just what the Fed chair wants, but what the committee as a whole wants. And that would be a very different dynamic from anything we've seen. But that's still about 11 months away from happening.
David, really appreciate the analysis. Thank you for coming in this morning. David
My pleasure.
Chief Economist for Developed Markets at Nomura. Coming up on the show, get ready to salivate at these next images. Snap, crackle, and pop. Kellogg shares rocket on a report of a takeover from Ferrero. Plus, Nvidia becomes the first company in history to reach a $4 trillion stock market valuation. We'll look at its growth story and what comes next. And we'll dig into Europe's startup scene with Peter Specht, general partner at early-stage venture capital firm Creandum. That's coming up at 8:30 BST. Well, we are waking up to mixed trade in Asia overnight. You can see the Nikkei 225 pulling back by about 0.4%. A bit of a stronger start to trade, though, in the Shanghai market. Shanghai Composite up 0.6. The Hang Seng also doing well. And over in Korea, a lot of focus on the Bank of Korea, which kept rates unchanged in its latest policy decision as expected. And you're seeing outperformance in the Kospi, 1.25% higher. In terms of European trade, yesterday, a strong day for European markets. We had the Xetra DAX closing at a fresh all-time high. Also strong performance in France and in Italy. The FTSE 100 lagging a little bit. Now this morning it looks as though we are continuing higher. The momentum continues to build in Europe. All the majors are poised for a stronger start to trade today yet again.
Right, let us move on because key industry players addressed day one of the OPEC seminar in Vienna, including Iranian oil minister who slammed the consequences of war-led disruptions to crude markets. With respect, sir, they weren't that long-lasting, were they? The minister's comments come after last month. In fact, there's more disruption when the Houthis sink a ship, isn't there, sir? And the Houthis are backed by... Oh, who are they backed by? Oh, yeah, Iran. The minister's comments come after last month's 12-day conflict between Israel and Iran sent oil prices spiking. Dan, you'd have heard my skepticism there about the Iranian perspective on things. But anyway, you have another great guest and another great former member of the club that used to run around all the hotels looking for ministers from OPEC.
Indeed, Steve. Good morning to you. Okay, let's dive straight into the conversation with Herman Wang, who joins us now. He's from Platts. Herms, great to see you. Welcome to the program. First of all, let's talk about what has been achieved so far. Lots of moving parts at this OPEC seminar, but what would you say is the key takeaway?
Well, I think we've heard that OPEC Plus, I mean, the market's trying to parse basically why OPEC Plus has been doing what they've done in the last couple of months and raising production quotas in a market that is relatively weak. And what are the motivations behind that? And what we've heard in the last couple of days is that OPEC Plus knows what they're doing. You know, the minister is saying trust the process. We control OPEC Plus, these 22 countries control some 40% of the market. So we have a pretty good pulse on what's going on. And what they see right now is that the market is actually perhaps tighter than what a lot of people think it is. People think that the market's oversupplied. But right now, we heard the UAE Energy Minister, Suhail Al-Mazrouei, yesterday tell reporters that, look, the market's been absorbing our barrels. There's not been a stock build, even though we've been releasing increasing amounts of oil every single month, last couple months. And that's an indication that the market is needing our barrels. And what we've seen is that the big question, of course, though, is what happens later this year, right? And this 2.2 million barrels per day of cuts that they are unwinding by October, what happens next? And certainly there are a lot of analysts, our analysts at S&P Global Commodity Insights, they see an oversupply potentially once these cuts are unwound of up to 600,000 barrels per day by October, and perhaps going even further than that by the end of the year. And if that bears true, the oil price could be well below what it is right now. And also, you know, this 2.2 million barrels per day of cuts, it's one of several layers of overlapping cuts involving different members. There's a total of 5.8 million barrels per day of cuts over the last couple of years that OPEC Plus has been doing. So once this round of 2.2 million barrels per day is up, what's next? In this group of 8 that's cutting, do all members continue to release barrels going forward? Or does it become a group of less than 8, a group of 1, Saudi Arabia, that's kind of dictating what's happening in this market with the consensus of the group, of course. You know, what's going to happen now? OPEC Plus, of course, would say that they are doing this monthly. They meet monthly. They're in control of the market. They can respond. They can accelerate the cuts, decelerate the cuts, pause the cuts as needed. And so that's going to be responsive to the needs of the market, even as it gives the market maybe a little less clarity on what's going to happen over the medium term.
Indeed, and I thought the Saudi energy minister made that point quite clearly yesterday during his speech. And yes, he stopped short of commenting on the most recent conflict in the region, but what he did say was really a doubling down on the energy transition, which some analysts have suggested might actually be OPEC maybe laying the groundwork here for maybe adding more barrels, saying that the world needs more oil to protect against these shocks. Are you reading much into that?
Yeah, I mean, one of the big themes here that we've heard at the OPEC seminar here is the need for the industry to keep investing. And now later today, OPEC is going to release their world oil outlook. That's their long-term oil market forecast. And if history holds the form, and I expect that it will, OPEC is probably going to double down on the notion that there's going to be no peak oil demand on the horizon, certainly not through the forecast period through 2050. And so the world's going to need a lot more oil. We've heard that from not only OPEC ministers, but also some of the CEOs, the big CEOs that came here from some of the big IOCs. That the world's going to need a lot more energy. You know, we hear a lot about AI energy demand, very energy intensive. It's going to ramp up energy demand. Now, that's not necessarily a direct correlation to oil per se, but we've also got the emerging markets of Africa and, of course, the huge key economies of China and India. They're going to drive a lot of what happens in the oil story. So, according to OPEC's accounting, the world's going to need a lot more oil, and accordingly, the world's going to need to invest in a lot more upstream production, and some of that involves OPEC members themselves. And again, we heard the UAE Energy Minister Suhail Al-Mazrouei say that even countries that are blessed with a lot of oil resources, they've got to pay attention to this. They've got to get more serious about investing in oil, because that call on OPEC crude is going to rise further as to meet this future demand. So, you know, we're going to need a lot more oil, and a lot of that has to come from the existing producers.
Talk to me about the geopolitics as well. This has been a real headline driver for the market. I thought it was interesting, and Steve made this point just before, so let's pick up on it. What we've seen is a ramp up of one incident, at least, in the Red Sea, Iran-backed Houthi rebels taking down this commercial ship. Of course, we also see the ceasefire talks between Iran and Israel holding. what is the status of geopolitics in the region, and to what extent is that impacting the price?
Yeah, absolutely. All this stuff that's happening, the OPEC plus decisions on production levels, the talk about the need to invest in energy transition, all this is happening in a market that has been as volatile as the Vienna weather has been this week. Right. And so it's a challenge for OPEC plus. And yes, there's not a lot of direct mentions of the war, of the geopolitics that have been influencing the market over the last couple months. But clearly, this is something that's top of mind, and obliquely, we've heard a lot of energy ministers talk about energy security, and that's become really, it started with the Russia-Ukraine war, and now the events of Israel-Iran, the conflict there, the 12-day conflict, that's really heightened the need, heightened the senses in terms of the need for energy security. The threats to the Strait of Hormuz, that's a critical waterway. 20% of the world's oil transits through that waterway. If in the very unlikely case that it is closed, it's a low probability, high impact event, and we all have to think about, how we get our oil out. And I know a lot of the countries in the Gulf region moving around oils, different pipelines, storage facilities to try and prepare themselves for the possibility that this could happen. You mentioned the attacks in the Red Sea. The Red Sea is another vital conduit for not just oil, but all kinds of shipping goods that transit through the Gulf, the Red Sea, the Bab al-Mandeb, as well as the Suez Canal. And we've seen what's happened with Red Sea shipping. A lot of shipping have to go around the Cape of Good Hope. Increasing costs, increasing time factors, disrupting global trade. So energy security really is coming to the forefront. And what we heard from the OPEC ministers and some of the CEOs here at the OPEC seminar is that let's be pragmatic about it. Right. Let's invest in energy security. We're not ignoring the energy transition. It's important. We got to do it. But let's also invest in energy security.
It's an excellent point. All right, Herman, we'll leave it there. Appreciate the conversation. Thank you.
Thank you.
Herman Wang there from Platts. Guys, with that, it's back over to you.
A terrific discussion, Dan. Thank you for bringing it to us. We are counting you down to the start of the European trading session. We are looking positive on the back of gains yesterday and across the trading week. We'll get you set up for the trading day.